Rishabh, I'm waiting for your second.
I think there's some challenge from YouTube side. I'll fix it. Give me a moment, please.
Sure. Yeah, so a very warm welcome to everyone present here in this session. Many thanks for joining us today. I am Vatsala Khare, lead of the mentorship program at SIIC, that is the Startup Incubation and Innovation Center, IIT Kanpur. We will be live from our YouTube handle of the incubator. You can view the recording of this session on our YouTube handle. Today's session is a bit different from the webinars that I bring to you. Today, we will be having a riveting fireside chat happening between an esteemed mentor from our official mentor pool of SIIC and an angel investor. Here, they will be trying to bring out the correct approach towards the first thought of investment that comes to an entrepreneur's mind. We have today with us Mr. Vijay Krishnamurthy, who will be the moderator for the session, and the angel investor is Mr. Girichandra Kuchangi. He will be sharing understanding and experiences with all the founders present here today. Mr. Krishnamurthy is a finance and legal professional and by qualification, a chartered accountant, company secretary, and a law graduate. He has worked in the corporate sector for about 30 years, including as positions as CFO and company secretary in ITC Zeneca, a biotech joint venture, Tata LHC, a publicly listed product engineering services company, and a Smart Play Technologies, a startup providing chip design services, which was subsequently acquired. Post his corporate career, Mr. Vijay has started his own consulting firm, Xenon Capital Advisors LLP, which works with startups and helps them with fundraising, mentorship, and scaling. He is also a mentor with the Stanford Seed Transformation Program and is helping a few of their companies on specific projects. He is also attached to our incubation center and other incubation institutes like IIT Mumbai, IIT Patna, Sastra University, and few other important institutes as a mentor. Mr. Girichandra Kuchangi is an early stage investor in the businesses. He is also a partner at One Crowd platform, a sector agnostic angel fund, and he has over 17 years of experience across investing, startup roles, investment banking, and software engineering. Mr. Kuchangi has served as Vice President of Investment Banking in the Royal Bank of Scotland and many other such important roles he has done in his previous career. He is an alumni of NIT Surathkal and IIM Calcutta. Mr. Kuchangi has advised numerous corporate houses in capital market transactions and cross-border merger and acquisitions. I do not wish to take more time, but let's start the session. Welcoming again both our esteemed speakers, and I would like to request to the audience that any questions shall be put in the question and answer chat box, and we will take them up as soon as the chat is over. Any remaining questions, we'll be taking them on offline also. Over to you, Vijay sir.
Thank you, Vatsala. Am I audible?
Yes.
Okay, yeah. So thank you, Vatsala. Thanks for having us here and organizing this quite relevant topic to the audience. So, um, just by way of context, investing in a startup is a very tricky business. There, there is no real, one formula which fits all situations. There's a bit of echo. Is that okay now?
Yes, it is okay now.
Okay, okay. So, I think, having Giri here is very, relevant, very important. And thanks, Giri, for your time to sort of give us perspectives from your side. Uh, so let me sort of get into the, questions. Let me ask Giri some questions and then he can elaborate on that and give us his perspectives on, as an angel investor, on what are the things which go into angel investing. So, so Giri, when a startup approaches you or when you evaluate a startup, there are multiple parameters. There could be, the sector in which the startup is in. There could be the revenues of the startup, the existing revenues. There could be the IP it has got. So, how do you evaluate all these different parameters? How do you bucket them? What is the type of weightage you give to all these things?
Sure. Thanks, Vatsala and Vijay. Happy to be here. Maybe before I answer Vijay's question, let me just quickly provide a context as to how we operate at OneCrowd, or rather, what is OneCrowd, right? OneCrowd is an early stage investor. We invest through an angel fund, and that means that the source of our capital is largely HNIs and family offices, and there is a certain nuance to the structure of the fund. But essentially, we invest, let's say, from seed to pre-series A, quite early if you look at the overall journey of a company. So that's where I come from. At OneCrowd, we are sector agnostic. Again, we have certain nuances within that, but broadly sector agnostic to that extent. We have invested in a lot of deep tech companies, a lot of B2B, SaaS, consumer as well. So that's the context, and most of the responses I provide is broadly in that context of early stage investing and investing quantums which are typically less than $1 million, right? So what do we look at OneCrowd? What kind of are the key factors, right? I think you ask any investor, typically venture investors, right? Venture investors, what are they looking for? They are looking for large outcomes, right? Typically, even though they're coming in at early stage, by nature of venture capital, and a lot of you might already know this, venture business is quite risky, right? So a lot of the companies do not make it to the finish line. So just mathematically, what does it mean is each of the bets that venture capital firm takes has to deliver a very large outcome, right? So then if you have that perspective when you're speaking to a VC, then you can sort of work backwards and see what does it mean, right, in terms of your own proposition. Large outcomes mean that compared to the size or compared to the stage at which, let's say, investor is entering your cap table, are you able to, whenever an exit happens, are you able to deliver, more than a 10x, ideally 50x, 100x, that kind of return? And then what does it mean? It means that is your market potential big enough, right? Are you operating in a very small niche, or is the market big enough? You can argue that I'll pick a niche and become a large player there. Possible, right? That's a possible option. But more sort of easily acceptable is there a fairly large market size that you are going after? And when we say market size, again, many of you might have already thought through this. There is something called total addressable market, but what really matters is, what is the relevant market for your product, for your service, for your customer profile that you have chosen, right? So you need to apply all the filters and then sort of figure out what is the real market size. So that market has to be fairly large. But as you would have all have heard this before market, the most important thing is a team, right? Because today you could be, given that it's fairly early stage, you could have started in a particular segment of the market. Tomorrow you might decide that you need to pivot to another market. All that is fine, but for all that to happen and move towards the success eventually, it's the team that pulls it off. So very important to see what is the founder profile, what is the sort of unique skill sets they bring to the table. Are they able to build a team, right? At the core, while founders can be scientists, they can have a proprietary product, all that is fine. It will take you to some extent, but unless you are a salesperson, unless you are able to convince people to even join you, right? And then convince investors to invest in you, and so on. This convincing part, it's not very intuitive to engineers, but founders at the core have to be salesmen, and I'm not talking about a typical salesman that you see is very outgoing and all that. I'm just saying you need to have that persuasive power and influencing power to make people believe in your story and in your mission, and get good guys on board, right? It's extremely important to build a solid team for startup. So I would pick the team and the market as important parameters. Beyond that, there are multiple things. The list can go on. Some people say tech, etc. But I would sort of I would categorize it into or bundle it into say, is there a unique IP or a unique proposition from the team, right? IP could be in terms of if it's a technical product, is this something hard for somebody to replicate or reverse engineer, etc. It could also be a non-tech process oriented company, or when it comes to consumer goods, it could be a new way of marketing or new way of packaging, right? But there has to be some uniqueness, which ideally is difficult to replicate and difficult to, a lot of plays, especially consumer plays, are execution plays. You need to get the execution right, you need to get the distribution right. Those kind of things are also, so there has to be some uniqueness in the company. Taking a step back, moving out from one crowd, if you look at the larger VC universe, a lot of people have different weightages for different things. But some of these basic things are quite common. What I mean by this is, for example, market size. Some people are okay with a very large market size. Some people are okay with niche market sizes. So that varies a bit, but everybody will look at some of these things for sure. Of course, there is multiple other things. A lot of it, because we are all humans, it depends on the prejudices of the person evaluating also, and hence you see some investors like certain stories, some investors give it a pass. All that happens, and at the end of the day, you only need one or two investors to believe in you at that stage. So yeah, so it's a long-winded answer, but I thought I probably gave you the gist of it. Yeah.
Yeah, thanks, Giri. My experience has been that one is a startup either has comes out with a new product altogether, so it's a new category, or they're doing an existing product in a more efficient way. So they've got some secret sauce of doing something. So these are typically, in my experience, the two type of startups I've seen coming. Either someone doing something totally new, not a new product or a new let's say new drug or molecule, or someone coming up with a new way of in logistics doing it more efficiently. But my experience has been that if you have revenues, it makes your job easier. That you can tell the investor that, look, I'm having revenues. If you don't have revenues, how difficult is it? How do you assess? If you may be convinced with the idea, but if the person is early stage and doesn't have revenues, what's your take on that?
I'll share my view on that, but there is on a lighter note, there's a saying that it's easier to raise money when you don't have any revenues. It's all plans. But once you start having even some bit of revenue, people will have 10 other questions saying, who who did this revenue come from, and why not somebody else, and so on. But having said that, I think at one crowd we typically prefer to invest after we see some revenue traction. which typically translates to a couple of crores a year. I'm just generalizing across the segments. Of course, we do invest, in exceptions where it's at such an idea stage. But we typically wait for some revenues. It's just a position in the spectrum of risk, in the sense, the assumption is that once you have a revenue, a history for a year, let's say, it usually also means that you have sold it to a bunch of customers, and customers have stuck with you for at least a year and a half. To some extent, you can call early PMF, right? So just a spectrum of the risk. There are investors who come in, once the product is ready, but maybe sales haven't happened. There are investors who come in at that stage as well. It's just that we come in later. So it's just purely risk appetite of the investor group. I won't say one is better than the other, because even if somebody has 2-3 crore of revenue, I think it's still, if you look at a typical 10-15 year journey of a startup until listing, it's still fairly early, and so many things can still go wrong. Yeah, within the seed to pre-series A, it's a bit of a variation, but I think it's still early. Even with 2-3 crores, I don't think PMF is fully established. There are several nuances that come into play as the company grows.
Got it. So I think it would be fair to say that, if even if you have lesser revenues, but you are able to establish that, you have a good revenue model, and your projections, you can defend your projections, then I think you can attract interest even with lesser than 2-3 crores.
Absolutely. I mean, as you said, depends on how well this product solves a customer problem, and various aspects of that, right? How difficult is it to sell to a customer? Maybe you have sold to 3 customers, but it took you a year to sell to those 3 customers. Then it becomes slightly of lesser interest to typically. These are general statements, not very specific to any one company. But if you have a product where it is solving the need of the customer so well that you're able to sell it pretty quickly, right? So that's an indicator. I'm talking more in the B2B context. It's a clear indicator that there is a need in the market, and the customer actually wants this product, right? So some of those nuances come into play. Also about stickiness. Again, coming to B2B software, typically we also see whether these are largely one-time revenues or revenues that recur, right? These are multi-year revenues or just one-time revenue. So the quality of revenue also matters. We look at any proposition, and again, depending on the context, whether a certain product has a roadmap where you can add features, or this is just a one-off product and there's no further extension. So what is the level of engagement possible with the customers? Whether it's specific to one small segment, or can you take this nationally, globally, etc. All those considerations. So broadly, you can call it as quality of revenues also matters.
Yeah, that's a very important point you sort of brought up, because if your cost of selling to acquire that revenue is going to be more than your revenue, then obviously you can't sustain it. So I think that quality of revenue is very important, because
absolutely, especially in B2C startup context. While it's a bit of a nuance in the sense, at very early stages, one shouldn't read into too much into your acquisition cost versus customer value, because the entrepreneur is still fine-tuning the proposition. But at some stage, one will have to take a call, as you rightly said. Am I acquiring this customer at too high a cost? And is there, after acquisition, am I sort of spending a lot to retain that customer? So does it make sense to spend so much to acquire and retain a customer versus how much margins I'm actually making over a lifetime? If that is unattractive, then obviously, while you might be selling, your bottom line is never going to improve. And I want to bring that into context. Again, your audience might already know this, but since last 18 months or so, world has changed in the sense that a lot of money used to fund a lot of high cash burn companies. That has become much more tougher. There's a lot more focus on profitability, path to profitability and so on. And that's largely because interest rates globally are high, and there are alternative avenues for investing that capital. And this might continue for long. It's good for the industry. But having said that, my own view is that there will be smart startups who will take a tactical view on when to invest and burn capital versus when to get to sustainability, depending on how much cash they have. And that might be a tactical sort of way to sort of outcompete your competition.
Got it. Then Giri, coming to valuation. So when a startup approaches you, how do you value that company? Because the founder himself or herself would have a particular valuation, but that is as per them. And how would you sort of counter that? And so what are the parameters you look at for valuation?
Right. Valuation is, there is a numerical angle to it, and then there are some other considerations as well. I think it's fair from let's talk from the founder's perspective, right? It's fair for them to go for the highest valuation possible, because at the end of the day, they would like to limit dilution. But that usually what that also means is that the founder should be able to continue that high valuation in subsequent rounds. As long as one can manage that, I think it works out. Generally, it works out over a long term if you can still manage to continue to raise at higher and higher valuations than, let's say, median. It typically works out for everyone because the founder still retains a decent amount of stake. Founder holding being inadequate never becomes an issue. So in that sense, it's good for everybody. And just going deeper in that point, there are several startups which, by the time they reach Series A, for various reasons, the founder holding would have fallen below 50%, which becomes a bit of a problem for subsequent investors. And the broad idea is, if the founders don't hold enough in the company, the idea is that there's not enough incentive for them to push this company. It's a broad thinking. At least in the early stage, the founder should have enough skin in the game, kind of thing. So hence it's a balance. While it's a conflict also, right? Early investors would ideally like to get a better price, and hence take a higher, result in a higher dilution of the company. So somewhere we need to achieve a balance. So it's a lot of it is case to case. In some B2B software companies, there are benchmarks also exist. Like SaaS companies, there is a certain revenue multiple range, and most of the early startups, people typically look at a revenue multiple kind of basis. Again, very early stage, there is hardly any metric on which you can base valuation on. So typically, it's a negotiated number. Typically, early angel dilutions are up to 10%, 5 to 10%. When you're dealing with individuals, it's a negotiation. Depending on how much they're investing. Let's say they're investing 2 crores, you want to give them 7%. The valuation could be somewhere in the 14 crore kind of range. So I would say that's a bit of a negotiation. Typically, when you start having some revenues, there are certain revenue benchmarks people typically look at. Based on that, some sort of valuation is derived, but it's again a value negotiation. As I said, if a founder comes across as a high quality founder and the prospects of the company look good, then investors typically are okay to assign a premium and agree for a higher valuation. Ballpark, you can look around, see some other companies that have raised. Early seed rounds typically happen in that up to 30 crore kind of, anywhere 15 to 30 crore kind of valuation. Pre-series A, up to 60, 70. Again, these are not benchmark. Generally, I'm saying there's no hard and fast rule around this. Typically, Series A, let's say 3 to 5 million raise, and typical dilution is 20-25%. So you could look at what that means. A 3 crore raise at 20% dilution is a 15 million post. So 12 million pre. So broadly, you can say 12 to 20 million is Series A valuations. I think from a founder's perspective, my recommendation is for them to look at how much they're diluting versus how much they're raising, right? Typically, each round you should not dilute more than 20%, ideally, at least in the initial rounds, and maybe that usually tapers down to 15 and 10% as you go for later rounds. So long and short, there's no perfect answer for this. If you can bargain one. So if you're confident of continuing to grow well, continue to raise the next round, it's in your favor if you can bargain a higher valuation.
Got it. So I think an important takeaway from what you said is that early stage companies, the valuation would be more based on at what stage
as I said, by the time, sorry, just one more point. By the time you come to Series A, as a dilution, typically 20%, right? Again, if investors are more after you to get this round done, maybe dilution will come down to 15%, but typically 15 to 25, right? So that kind of indicates a range of valuation also depending on how much you are trying to raise, right? And a lot of funds also have their minimum stake criteria. Somebody would say, I need a minimum of 12% or 15% holdings, and I can invest only 4 million, for example. So that also in some sense for that investor indicates the maximum valuation that they can come at. So there are many factors, it's always a good idea to talk to people and, form your opinion.
Got it. And I think the founder should also be flexible to accept a different valuation because what aligns, because it needs to be a win-win approach between the founder and the investor. So yeah,
absolutely. Some of the better founders that we have seen don't make this the number one point. As you rightly said, whether his business plan is fully funded and whether the money comes in time are more important factors for them rather than have achieved the most optimum valuation, right? So it's an approach to life. If you would like to close the deal quickly and move on and ensure you continue to grow quickly rather than waiting another 6 months to raise the valuation that you desire, it's a bit of a trade-off.
True. Giri, can you explain a bit about the angel platform and especially in the context of OneCrowd? How does it work? What is the minimum amount an investor can invest? And do you put in money from your side?
Sure.
So just and the time limit, the process.
Yeah. Right. I'm happy to do that. So OneCrowd, we are a bit of a hybrid of a micro VC and a angel syndicate. In that sense, I and my team, we look at every transaction like a typical VC does. So we need to be first convinced that this is something that we would like to invest in, and go through the whole IC process, and then we determine that OneCrowd will also invest its own share, and then we have a syndicate of angels to whom we showcase a transaction, and then we build a book and seek commitments, and the investment happens through a AIF, angel fund scheme. So we take one entry in the cap table. Typical timelines probably about 2 months. We don't rush into a deal. We would like to understand the founder as well as the investment case better, and we do a lot of other checks at our end, which takes some time. So we've stayed away from deals where you talk to the founder today and need to close the deal in 1 week. That used to happen. Now it's coming down a bit. That's at a high level OneCrowd process. There are variations to this. There are multiple sort of micro VCs and platforms that are available as alternatives in India. Some of them leave the decision directly to the individual investors, the group members, and startups get to do a pitch to them. So there are some variations. So we have a bit of a hybrid approach because we also get hands-on involved after investments and work very closely with the founders. So we are very careful in the startups that we pick. Yeah.
So all the investors who sort of subscribe to a particular startup, who put money in a startup, they would come into a SPV or a entity formed, and that
It's
entity
a
will
fund.
invest.
It's a SEBI. Correct. It's an AIF angel fund. So these investors, LPs, have to subscribe to our fund. There are certain minimum amounts to be deployed and so on. And because ours is an angel fund, they have the flexibility to pick and choose the deals they would like. Let's say we have 100 members. 20 of them might be interested in a deep tech startup, whereas other 20 might be invested in a biotech startup, while biotech may not appeal to everybody. So those particular 20-30 people who are interested will come into this a new scheme that is devised for investing in that particular startup.
Got it. And if a startup approaches you with, say, a valuation of, say, 20 crores, then on that basis, investment would be attracted, or would they sort of negotiate the 20 crores?
In our platform, so the One Crowd team works with the startup. After our evaluation and once we decide to go ahead, we share a term sheet. Sorry about that. So we share something called a term sheet, and this is what most investors do, right? Which captures the key terms that we propose to invest, the basis on which we propose to invest, and that includes valuation as a parameter. Sometimes there is a bit of negotiation. Again, when there are, in the industry, what happens is typically there's somebody called a lead investor who, let's say, is taking significant chunk of the round size. So they typically set the valuation. So there is a way in which the industry operates where this kind of coordination happens. But typically, investor has to agree to that valuation. And term sheet is a document which lists all that along with the key terms of the investment.
Okay, got it. Okay, Giri, in your experience, can you give some examples of some startups which have fared well and why they fared well, and some startups which didn't do well and why they didn't do well, just as a learning?
Sure. I think as I said, just to recap, we are sector agnostic investors, which means that we have invested in multiple sectors. So without taking names, let me sort of characterize, important features of startups which are doing well. And most of our startups are still in that early stage because we are early investors. So, it's not like these startups have reached IPO stage or anything like that. But, we have already seen that, some of them are doing well and some of them are facing some constraints. So, I think it goes back to the criteria that I also listed as important. I think the most important is the strong founder fit to the industry. Not just product market fit, but also founder fit to the industry. Is the founder coming with a unique understanding of the industry? How well he understands the problem of the customer? Is he able to respond quickly to customers' needs and in a unique way, right? So how strong is the proposition in that sense? Is that proposition difficult to replace as well? Because occasionally what also happens is we've seen, and these are the not successful companies, we've seen companies have found initial traction with the customer doing very well, but suddenly after 2 years, they find out that somebody else has replaced them and they lost the contract, right? With good companies, their products are such that it's become indispensable with the customer. So it's kind of strong lock-in factor there, right? I think one factor we've seen with a lot of engineer founder teams is as they move into pre-series A and towards series A, are they able to or are they able to sell themselves, or are they able to bring experienced salespeople? Again, depending on the stage, the kind of salespeople you have varies. Before Series A, it's difficult to afford very experienced sales guys. But amongst the team or they themselves, can you effectively sell to a customer? Not just the initial customers, right? Because the initial customers usually come from friends and family and references and all that kind of thing. But can you do a bit of a cold calling and convince customers who have never heard of you before? So that sales function is very important. And unfortunately, we see a lot of engineer-led startups completely ignore that part, right? Sometimes there is this feeling that I have a great product and the product will sell for itself. Unfortunately, rarely happens that way. So that sales mindset, and the sales mindset also plays out in a slightly different way. Is the founder able to engage investors and prepare for the next round, right? That's a bit of a skill set that not everybody carries, but it's a very important skill set. Sometimes we even see that if there are 2-3 founders, it's better to allocate one founder to full-time fundraising. I'm not saying that it's unsustainable startups, but timely availability of capital is crucial for every startup. And fundraising is typically a 6 to 9 month process, unfortunately, and it sucks away so much time of the founders. So if the founder is really good at it, right, fundraising is that much easier. Yeah, successive startups are able to navigate all this very well. And without sort of sounding very generic, persistence we have seen is very important, right? Every startup goes through a bit of a rough patch once in a while. Either suddenly customers have stopped using your product, or some of your team members suddenly left, or whatever, right? Does the founder have the persistence and tenacity to hang around there? Because a lot of these are phases, and they say that startup sheds when the founder gives up. So there'll be a lot of problems that come up every day. Some very grave problems. So can the founders hang in there and find solutions without giving up is a very important characteristic. Right? I'll quickly cover a few reasons why we have seen some startups fail. I think sometimes the market that we thought is there is actually not there, right? It may be because the product might be nice to have, but nobody desperately needs to have it, or stuff like that, or the use case has completely changed. A lot of this work was happening in AI in terms of image generation and all that. Now with, let's say, technology disruption, Gen AI coming along, a bunch of startups have gone out of favor. Right, so there might be technology changes that might result in this. We have seen, unfortunately, sometimes if there are let's say 3 or 4 founders, unfortunately, and not just with us in the industry, there is at some point there is misunderstanding between the founders. Right, so it's very important to pick your founders, because once misunderstanding starts between founders, the company kind of loses its path, and that a lot of work gets undone. People are doing things in their own way, and there's no cohesion and so on. It's extremely important for the founding team to have find co-founders where there is a lot of goodwill and synergy and intent to work together. I would recommend not to sort of find co-founders who you just met in the co-working spaces and seems like we have complementary skills. It takes a lot more meeting of minds, because typically startup journeys are fairly long and goes through lots of ups and downs. Last point I want to bring up is improper cash planning, I would say, runway planning. A lot of founders not so much involved with planning the resources that they have, and then suddenly they realize that there are certain payables which are due, and then once they clear the payables, there's no money left in the bank, or you're left with only 2-3 months runway. So extremely important to plan your runway. I'm not saying that you have to be profitable from day one. A lot of startups typically need to invest a lot to get to a stage where they can compete. But extremely important to plan your runway and plan your next fundraise and plan in advance how you're going to position yourself in front of the investors for the next fundraise.
Got it. Thanks, Giri. That is quite useful. And just one last final question before we ask the audience their question. If anyone wants to approach One Crowd for investment, what is the process they should follow?
I think what works best is because there is it's just our own way of looking at startup leads. We are of course happy to talk to anybody who approaches us directly, but we prefer that we look at leads which comes through our ecosystem partners, because then there is some level of curation that has happened, and our partners would know what stage that we invest in, and is it something that we can do, and there is some incubation or some acceleration that has happened through the partner. So, for example, this kind of audience, let me, for example, I would say, either recommended by Vatsala or Vijay yourself. If you think this is startup that we should look at, we are very happy to look at. And typically that's how it works largely in the industry. If you go through certain references or through incubators and accelerators, it's easier to get attention of investors. But nothing stops any hustling founders to reach out, cold calls, etc. Think of it like another sales effort that you're doing if you want to reach out to investors.
True. And, thanks, Giri. That was really useful perspectives on several fronts. Vatsala, I'll like to sort of hand it back to you, and for the audience to ask any questions they have.
Yes.
So over to you.
Yes, thank you so much. Thank you so much to both of you. I'll first read out the questions. First is Pranav. He is an incubated startup. He's asking what is the timeline for success considered when real market size is considered as very large. He's telling about himself that he's moving in sales slowly, but since government work and high ticket products, they took 2 years to fetch their first order after the election period. So he's asking about what are the phases in success. Giri, we cannot hear you.
Now? Yeah.
Can you speak again?
Yeah, can you hear me now?
Yes, better, fine.
Yeah, so I think typically investors start monitoring a startup when you've made your first sale, right? Of course, it's also important to see how long the sale took. But once you made your first sale, that's when people also try to see when is the next sale happening. But in general, if the sale is taking too long, maybe there are certain reasons why the first sale took a year. But if the sales typically takes too long, then there has to be a reason. People will need to understand why it's taking too long. As I said, typically preference is for sales which can happen faster. Because then, let's say you made your first crore or 2 crore in your first sale. If it's going to take another year to do the next sale, so for you to get to 4 crores, it will take you 2 years and that much longer, right? So, really depends on what kind of sales value you're going to get after that 1 year of sale. But the other way to also look at this is, can you build your team such that you can chase multiple of these opportunities at the same time, so that they can close with a certain periodicity, even if it takes 1 year to close. Starting next year, can you start closing these every quarter, right? If it's really going to be sale a year, I think it will be a difficult sell. I'll also add that unfortunately, if the companies are heavy on government contracts, people also are a little wary, just because timelines of execution may not be in your control, or payment timelines may not be in control. Again, not true in all situations, but something that people would like to understand better. I hope I have answered that question.
Yeah. Another question is by another startup, Ardan Labs. He's asking that they are a hardware aerospace startup building a propulsion system in India. We are seeking a round for prototype development and will need to frequent raises till their MVP. How should they approach this without diluting too much of equity?
Yes, you're saying equity, I guess what you mean is a convertible round or a safe note kind of structure versus a priced round, right? Now, again, I would say this is just one variation of your overall negotiation, right? There are some set of investors who are okay with the CCP or a convertible approach, who don't mind not knowing a value they're entering at. And typically these safe notes or convertibles have a 20% discount. For some investors, this is too less a discount for them to get into. They say I'm coming in at a high risk situation and I'm getting only 20% here until the next raise. So it really it definitely works in favor of the company because you can push out the valuation decision down the line until you created a product and found some monetization for that. But it's a bit of a balance. If you're able to find investors who are ready to come in at that convertible, why not? We've seen people do that. It's not unusual. Sometimes it's better to push down the valuation decision until you have certain metrics on which you can value yourself. So deals do happen, but I would say half of the market is open to such kind of deals. Not everybody does convertibles.
Thank you. The next question is it possible to get an honest assessment of a startup's product team, potential, and state without seeking investment from you?
Without seeking investment is a little tricky one because this gets into a territory of mentors and incubation centers, right? Where they are helping you assess all this and fine tune. Once in a while, investors are happy to do this, but it's just that there is no business inside. Then it becomes difficult for people to engage. So I would say that the incubation accelerators are the best place for you to sort of get assessed on this.
Correct. So Amrit, we do have mentors with us who can help you for this. Thanks for your question. So the next question is, yeah. So Pushkar is asking, do investors invest in research and development startups? Is that true?
Yeah, so I read the question and he says it's sorry to see. Pushkar, see, there are two parts to this. One, in one crore, we have invested in a couple of deep tech startups where revenue has not started, right? Revenue is down the line, 3-4 years down the line. But there is a reason we have invested in those, right? You'll have to look at investors as people who are looking, come here to make money, right? At the end of the day, people are deploying their hard-earned money, and they have a certain return profile in mind. The problem with R&D startups is, unless you are able to demonstrate that, okay, investors will wait for 5 years, but what after 5 years, right? The more certainty you are able to give to investors that after 5 years, there is going to be a fairly unique product which is also monetizable, right? Unless that, kind of you're able to convince the investors, why would investors deploy money, right? So, I think this is a good question. You need to have this perspective, right? VCs are not the answer for all startup funding. There are certain kinds of funding that works well for VCs, which, as I said, it has to be a fairly large outcome and deliver returns. Again, from a startup perspective, VC funding is not the only way, right? You can look to build a sustainable startup from day one, fund it entirely out of customer revenues, right? And then possibly there are other sources of capital, bank finance or government finance. So one should explore everything, but also be very clear that VCs are here to make money, right? And they are taking very risky bets, a large portion of those risky bets don't work out. So whatever works out does really needs to work out with a large outcome. So that's the reality. So within that, even if it's a R&D startup, if there is a large outcome possible after 5 years, even though there is no revenue till those 5 years, those kind of startups get funded.
Yeah. In fact, I just want to add here, there's the technology development fund. So, it's a government fund where they will invest in companies on the R&D side. So maybe, as Giri was saying, VCs are not the answer for every funding situation. You could explore other avenues, especially the government ones for R&D funding.
Thank you, sir. Next question is, can you put some light on financial commercial parameters that matters to your team, that is One Crowd? And can you share an example of such analysis of a startup that was successful from your point of view, which had ups and downs? I think you've done.
Not sure what he means by financial commercial parameters. As I said, I think I mentioned that we typically look for revenue traction. It's probably something of the order of 2 to 3 crores of annual revenue to begin with. Of course, it can be a bigger startup making higher revenues, and we'll consider it a slightly later stage startup. In terms of valuations at that stage, typically it's between 20 to 30 crores because it's still fairly early kind of startup, right? Founder holding, we would ideally like it to be as high as possible at this early stage. Typically, investors like us will want you to create a ESOP pool before we invest, and typically that's in the order of 8 to 10%. And the idea there is that this ESOP pool is used to attract, your team, because development of team is very important. So I think some of those, we also, all of us also look at what are your margins, what is your burn level, with this round of funding, are you able to sustain for at least 18 months, 15 to 18 months, right? We don't want you to have a business plan where you exhaust the money raised in 6 months, and then what happens is by the end of 5th month, you're back to fundraising mode. So the company is not able to move forward. So typically investors would like the money to, like the company to sustain with the money for at least a year and a half, and make certain progress, move to the next milestone where you are able to get the next fundraise. I'm not sure if that was what you were asking, but yeah, some of those points.
Yeah. So the next question is, what is the revenue number that attracts investors? And after seed funding round, when should the next round be raised?
Yeah, again, nothing hard and fast about this. As I said, we typically look at 2 to 3 crores as a entry point in annual revenues. There are enough investors who come in at zero revenues. Many investors would like to have a cutoff of $1 million annual revenue. Some of the larger investors, for some large investors, it's 2 million, right? Some Series A plus investors, the minimum 2 million revenue. Again, it's a lot of this is specific to the startup in terms of assessment of how big this company can become. But these are sort of rough benchmarks. At seed stage, I said a couple of crores of revenue, but there are enough seed investors who can come in after you're done with your first sale, right? So that might mean 50 lakhs of revenue, annual revenue. What was the second question? Sorry.
So the second question, the second question was, when should they raise their second fund?
Next round, yeah. As I said, when you raise your seed round, plan for at least a 15 to 18 month runway. Couple of factors for that, if you plan for 15 to 18 months, typically something comes up and it gets shrunk to 12 to 15 months. So have a buffer. So raise at least enough to get to a 15, 18 month runway. Of course, if your startup is not losing money, then that becomes less of a factor. You can always raise your next round when the next milestone is achieved. But for the investors also, they need to see some development, some you should have achieved some milestone after your last raise, right? So plan it such a way that you identify milestones, and that is your runway kind of satisfies reaching that milestone.
What is a typical funding ticket size with one crowd for a pre-seed or a seed stage startup?
We typically do up to 500K funding at this stage here.
Okay. So my startup has developed gas sensors, which is a product used in industry. While I discussed with some investors, on average, I received a reply that such products get investments either from USA or Singapore.
I don't know what to make out of it. So the way we would look at it is, is there customer feedback, customer interest? Are you able to sell to a customer, right? Whether the customer is India or US. If that is demonstrated, then I think funding will happen in India. Unless, this is a product which doesn't have any applications in India, which is also fine, as long as you're able to demonstrate that you're able to sell in the US. I think you should be able to get funding. I mean, unless you are saying that it's still at a product development stage where you're still to establish customer interest or the use case, it's not very clear whether customers will adopt it. Maybe there are some of those nuances. But otherwise, what's encouraging is in the last couple of years, there's a good deep tech ecosystem that has come up in India. So there are now decent amounts of funds that look for original, proprietary products or new innovative products from India.
Pushkar, we have unmuted you. If we could not answer your question, please, you can talk with us. Okay. I'll take the next question. The next question is, yeah.
Yeah, I'm trying to unmute him. Okay. Just ask him to raise his hand.
Pushkar, please raise your hand.
Revenue recurring and assured revenue and so on. So some of those factors are cause for concern. It could be with any investor. It's just that the way the government tenders work or government contracts work, some of these could be concerns. But having said that, to put this in perspective, you may know one of the most successful startups that have listed recently is IdeaForge. And IdeaForge's client base, to my understanding, largely government orders. So there's definitely scope for these kind of startups, but you just need to make sure your revenues and collections are attractive, right, and recurring and long term.
Thank you, Pushkar. We have unmuted you. You may please.
Hello. Hi, Vatsala, and hello, Mr. Girichandra and Vijay.
Hi.
I asked particular question, particularly about gas sensor, as well as it was for the technology, research and technology. Research and technology, fantastically you have answered, as well as even the insights that were given for the gas sensors. I agree and I appreciate. I have to say that I definitely have got my answer through your deliberation. Thanks.
Okay, thanks, Vishwa. Thank you. We have another incubated startup, sir, Novo Earth. He's saying thank you for the session, and they're in middle of a fundraise process, and I've already got one term sheet. Can they reach out to you for this round? Okay, you've already.
Yeah, we will be happy to have them. Yeah.
Thank you. So we'll be connecting. Yeah, thank you. This was a perk of this session that One Crowd has agreed to screen our startups and help them if they feel.
No, I think I should share this, that a lot of good work is happening in incubation centers, especially IITs. and also promoted by ISC and BIRACs or the like. Very important work that's happening in promoting startups. And for us, really, it's a way that the help that all the incubation centers provide in fine-tuning the story of the startups and making them investment ready is a very important value addition. So it's a great ecosystem, and we hope that it only develops much more.
So yeah, we're at the end of the questions, and thank you to both of you for this valuable learning experience during the chat. The knowledge and the insights that you both shared must have had a significant impact on the understanding of the topic. And of course, the practical applications and the step-by-step guidance that you've given were highly valuable. And especially thank you so much, Vijay sir, for bringing Mr. Girichandra here with us. And certainly, sir, we'll get back to you with our startups who are in the stage of investment.
Great. Thank you, Vatsala.
Yeah.
Thank you,
so
Vatsala,
much.
for having us. Yeah,
Our pleasure to be here. Thanks.
Thank you everyone for joining here.
Thanks, Giri. Thanks.
Thank you.
Bye-bye.
We'll be putting up this
Thanks,
session
Giri.
on YouTube, and after that, I'll share the recording.
Thank you.
Thank you, everyone. Thank you. Have a good day. Bye bye.